Hey traders, Gavin McMaster here from Options Trading IQ, and today I've got 3 trade ideas for you for August the 15th. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So the first one I've got today is on Marriott International. I found this one because it is below the 3 key moving averages that I watch. So it's below the 21, which is green, the 50 in blue, and the 200 in red. The 21 and the 50 are pointing lower, so the trend is clearly down. We're also seeing quite a lot of distribution occurring in the stock over the last 6 months. So we can see that here with the accumulation distribution indicator, money flowing out of the stock. Now, the market has bounced since early August, but Marriott hasn't really bounced that strongly in comparison. And I think it still looks pretty weak. And I've come up with a bearish trade that I think you'll like. So this is a bearish butterfly, a directional butterfly, whatever you want to call it. But basically, we're looking at roughly a price target of 200 on MAR in the next couple of weeks. So we're buying the 190 strike, selling the 200 strike, and buying the 210 strike. So I've got 5 contracts here. That's going to cost about $500. So that's our max risk. And the maximum gain is around 4,500. But we're not really aiming for this top section of the triangle of our butterfly. We want to just sort of follow this T+0 line. And with any luck, MAR comes down towards 200 in the next few days. We could be up $500, $600, $700. In terms of a stop loss, I would set it at half of the cost of the trade. So trade costs about $500. I'd have a stop loss of $250. That could occur if MAR rallies to 223, 224 in the next few days, or if it doesn't make a move lower, we might suffer a bit of time decay. This purple line will come down slowly and meet this blue line. So we don't want to hold it too long. Roughly $250 stop loss and profit target anywhere above $500. And we'll see that's our T+0 line. If we change that to, say, the end of the month, you can see looking pretty good. Anywhere down to even below 200, about 197.5. The trade could be up potentially $1,000, depending on changes in volatility and bid-ask spreads and things like that. But very, very high reward potential on this one if the stock does drop lower. The other thing I was thinking with this trade is, if we are going into a recession, cost of living pressures are hurting people. One of the first things people are going to cut back on is vacations. So the Marriott may see a drop in reservations, could hurt the stock going forward. And technically, it was below all those moving averages. So again, pretty good bearish candidate. Next trade I've got for you is on Netflix. Now, this one showed up because it had a nice cross above the 50-day moving average. So unlike Marriott, Netflix here is above all 3 of these key moving averages, which is great. It's had a much stronger bounce in the last couple of weeks, and we're actually breaking out above that 50-day moving average and putting in a couple of really good bullish candles here. So I think this looks like a really good bullish candidate. Really nice day yesterday, up 2%, so outperforming the market. And we're seeing a real uptick in the money flow indicator here as well. So again, looks like people are buying into this rally. Money's flowing into the stock. So the trade's a pretty simple bull put spread. 15 delta on the short strike. So we'll sell the 605 put, buy the 600 put. We're going to do 2 contracts of those, generating about $120, $130 in premium. Let's change our T+0 line back. And risking about 870. In terms of an adjustment point, if Netflix gets down to about 632 around here, somewhere between 630, 635, anywhere in this zone here is where I'll adjust the trade. Now, that could be doing a defensive roll, adding some call spreads on the upside, or doing a delta hedge. I'll decide when that, if and when that occurs. If not, 50% profit target, basically half the premium received. Let's say we get 130. If the profit is 65, within a couple of weeks, I would take the profit and close that out early. Okay, and the last one is a diagonal call spread for NVDA earnings. I love doing this on tech stocks in the run up to earnings. We can take advantage of the volatility skew. We're selling the high vol at 80. We're going out 2 weeks and buying the lower vol at 70. So we're letting that skew work in our favor. This is the first expiration after earnings on August 28th. And we're selling that 15 delta. That's the level I like on diagonals and put spreads and condors. And then for the next strike, we go out 2 weeks and we buy something around about the same price or slightly lower. Ideally, that works out to be about 5 points wide. Again, with 2 contracts, it's similar risk, same as a credit spread. 5 points wide times 2 contracts, about 1,000 at risk, less the credit we receive. And the credit in this case is about $20. So we have no risk on the upside. NVIDIA could go to 150, 160, doesn't matter. The puts will just expire worthless. We keep the $20 credit that we received for a small 2% return. What we're looking for is kind of some flat action in NVIDIA between now and a day or two before earnings. So you can see our T+0 line here. The upside doesn't hurt us at all. NVIDIA can go as high as it likes, doesn't matter. What hurts us is a big move down early in the trade. But if it slowly moves down, and say we're a day or two out from earnings, and we're down here in this range, 105, 110, we're actually looking really good. Now the skew is going to get steeper. It's going to worsen. This number will get higher. So the skew is going to move against us, but we're going to get a lot of time decay, and hopefully that will offset. So really, between now and about August 27th, so about 12 days from now, anywhere between sort of 100 and 130, 135, we're going to be looking really good. So it's a nice wide range, and we should be able to get out, hopefully, with about a 10% return. For this position size, that'd be about $100, and we'd set a similar stop loss, or if the stock breaks through that short strike of 101, we might close it out early. The other thing you can sometimes do with these, if you are willing to hold through earnings and you like the stock, you can actually just let these get assigned and turn it into a wheel trade. So that's a potential as well. If you did want to try and hold through earnings and you like the stock and you're happy to buy it at 101, you can buy the stock there, let them get assigned. And that's, of course, if the stock drops. The stock may not drop after earnings. It may stay well above 101. So there you go, 3 ideas for tomorrow or today, depending on when you're watching this. Hope you have a great day. Best of luck, and I'll talk to you soon.